So to talk more about what we can expect from the Fed, I'm joined now by Tyson, Head of Strategy for Interest Rate Products at MF Global. He oversees all trade strategies and research on interest rates and exchange-traded derivatives, options and futures for the group. Good to see you, Mr. Tyson. Thank you very much indeed for speaking to us.
No problem.
I mean, the broad expectation seems to be right now that we're not going to see QE3, but is it something that the Fed needs to consider when you look at the raft of weak data that we've had, and when you look at the impact of QE2 on the US economy right now, the direction of the US economy?
I think it's something that we can't rule out, but I think we're a long way from that point just yet. I think the Fed tonight will acknowledge the slowdown in the activity numbers that we've seen, but they're not going to be bounced into a QE3 decision just yet, because I think that they feel that a lot of the factors that have weighed on growth in the first quarter are temporary in nature, such as the poor weather, the rise in energy prices and commodity prices, etc., and supply disruptions. They'll want to see if they're unwound over the next few months. The other thing is that underlying inflation is actually picked up. It's still low, but it's picked up, and it's higher than it was when they launched QE2. So they'll be wary about the widespread criticism they received last time when they launched QE2. So I think that there'd have to be a significant weakening in the data from here for the Fed to sanction any more sort of policy easing. So I think that's something for next year, really.
So does that mean, I mean, you were pointing to inflation rising. Does that mean that QE2 quantitative easing could have done more harm than good when you look at rising commodity prices? I mean, given that it was designed to help the economy to stave off deflation, okay, you know, deflation might not be a threat right now, but then what about the other effects?
I think the impact of quantitative easing is questionable, as you say. I mean, commodity prices have backed up. The impact on long rates is unclear. So they definitely won't want to be pushed into doing more QE any sooner. It's interesting, actually, that the market expectations have sort of been scaled back significantly recently, and now we're looking at the first Fed hike 12 to 13 months down the line from here. Traditionally, the market's had problems pushing out the on-hold period beyond sort of 12 or 13 months in the absence of more QE. So I really do think that you know, we would have to see more QE to get any further scaling back of expectations from here.
Given that unemployment, given that unemployment is stubbornly high, some would say, growth extremely low, how helpful has QE actually been?
Yeah, as I say, it's difficult to gauge exactly how helpful it's been from here. And in fact, if you look at, it's interesting, if you look at charts of 10-year bond yields, you can actually see that in periods when you've had QE, yields have actually risen, which is the inverse to what you'd expect should happen. So I think because of that, they will be very wary, you know, particularly given the impact of potential fiscal tightening next year on growth as well, without being rushed into anything.
Yeah, what does that mean then? How might markets react when QE draws to a close?
I think that, you know, it's not going to have any material impact on 10-year Treasury yields or the US bond market as a whole from here. I think what will drive US bonds is really the fundamental outlook, what's happening to activity, what's happening to prices. It's not going to be the end of QE2. That's not going to lead to a sort of a significant rise in yields from here. So it's still going to be very much driven by what's actually going on in the economy itself.